what do you expect for the next 4 years of a Trump presidency?
Looking at what this election was about, and when you look at the data numbers, it was about the economy, in my opinion.
So whenever you're seeing a clear mandate from the election, that's going to end up being positive for markets.
Scott, good points. Coming off a nice haircut you brought to the table today as well. Today is Wednesday, November 20th, 2024, and this is The Bash. Welcome to The Bash, where we bring the analyst and planner to the table to discuss relevant financial and investment topics. We're going to have 60 seconds to discuss each topic. Scott, before we jump to the headlines, my man, the analyst, give me something good that's going to be going on with you and the family over the upcoming holidays.
Matt, great to see you again. I'm very excited for Thanksgiving, spending time with my amazing family, my wife and 3 kids. I'm looking forward to it. Should be fun. How about you?
Scott, keeping it simple, same over here. Family, kids, amazing. So let's move on. Let's move forward. A lot going on. Trump won. He's now going to be the new president, and the market has reacted. Scott, what have you seen so far?
Well, Matt, historically, when it comes to presidential elections, we do see varied results right after. We tend to see an immediate reaction. That's a knee-jerk reaction where investors are rebalancing their portfolios for the winner that they perceive to be policy changes. In this case, with Trump winning and having a decisive victory, that leads to a positive result in first-year trends as well. So whenever you're seeing a clear mandate from the election, that's going to end up being positive for markets. So the immediate reaction was the rebalancing. We're going to see some first-year trends because we did see a mandate, and then we're going to move into some of those party trends.
I was like, I want a party.
Typically, with the Republicans, you're going to see a little deregulation, lower taxes, better for energy, better for financials. With the Democrats, you're going to see better performance in sectors like renewable energy. But when it comes to the actual results, look at the last 2 elections. Trump won in 2016, market surged. Biden won in 2020, market surged for the opposite reasons.
Thank you, Scott. And to back some of what you said, I see optimism, euphoria.
Except for a slight wave of euphoria. You feel it?
I even said that right. What's going on? I'm looking at what this election was about, and when you look at the data numbers, it was about the economy, in my opinion. So let's talk about that optimism and what investors are doing. Think about this. The U.S. equity exchange traded and mutual funds drew nearly $56 billion in the last week ending this past Wednesday. That was the second largest weekly haul in records going back to 2008. So investors are putting a lot more money into the market. And what's driving that optimism? I think you just mentioned earlier, expectation of lower taxes and less regulation, and that is potentially more profitable for corporations.
I like to make money.
So this may have been a short-term relief rally, and look, this data is not surprising because if you go back to the data that came from the polls, it showed that 2/3 of the voters rate the economy as poor or not so good right now. And did you know that 69% of them voted for Donald Trump? So right now, that euphoria, optimism is flowing into the market, in my opinion, right now.
Yeah, well said. But let's move forward. Let's talk about now the next 4 years, because now the past is the past, the election's over. But what do you expect for the next 4 years of a Trump presidency?
Well, we just focused on Trump, and I'm actually going to say let's take a step back and not focus on Trump, because I believe the market in the long run is based on a lot more things other than policy, which to me is more short-term noise. So I think we're going to have a move back to, when the dust settles here, the fundamentals of what are we doing with inflation? How is unemployment? Are we going to prevent an upcoming recession? That's where the market will eventually start to put its focus on. And then I'm going to look at the history of the market. Data showing that usually the market works in cycles. So I would not be surprised if there is a pullback or a recession over the next 4 years at some point, because that is what happened over time.
For all our sakes, I hope you are wrong.
But then in the long run, and most likely after these 4 years, if you look at the majority of elections, they are positive, the results. The market, to me, is based on innovation and companies doing what they do best, which is improving their earnings over time. So I would say after 4 years, I would not be surprised if the market is higher than it is today.
Fine with me.
Scott?
Matt, predicting the next 4 years of a Trump presidency involves considering his past policies, his campaign promises, and the current political and economic climate that we are in. Let's start there with the economic policy. Tax reform. He's obviously going to want to extend or make permanent his tax cuts. Regulatory rollbacks, infrastructure spending. Yes, better known as deficit spending. Let's move on to trade and foreign policy. A return to this more confrontational stance with China and overall global trade wars. Healthcare policies, social policies, a variety of changes is what we should be expecting. Fiscal deficits to grow. Global relations, what's going to happen with some of our trade partners. But there's opportunities for economic growth, technological innovation. So we cannot predict the future. We can simply look at the past and clearly understand that the past does not repeat, but it does rhyme.
Scott, good points, and really got some good insight there about the future of possibly the market and its effects. But we're going to turn to a whole nother area of financial planning or investment management, and we're going to talk about company benefits. And we run into this a lot with our clients. They come to us and they bring up topics such as HSA, 401ks, RSUs, SOs, etc. Scott, how do we help our clients that are participants or even owners in those type of company plans make decisions on those topics?
And I believe we're in the open enrollment period for a lot of companies. So this is very relevant for so many people out there. And understanding your benefits, it could feel very overwhelming. There's different aspects that you really need to be in tune with. So let's start with, you've got to understand your options. You've got to review the benefits package. You have to know what's available to you on the health side with your medical coverage, on your retirement side. What are the different types of retirement plans that are out there? Also, some of those perks that are out there that so many of our clients and employees out there that we see, they just don't take advantage of it.
I had no idea.
Like profit sharing plan or being able to buy company stock at a reduced price. So when it comes to your benefits package, one of the things that I would strongly recommend is reviewing the entire package with your financial advisor. Your health coverage, the medical side, your insurance, life insurance, disability, and then the retirement plans, which are very vast, it's very broad, and you have to have a clear understanding of what's best for you. I would recommend always reviewing this with either the advisor on the plan or your own personal financial advisor.
Scott, great points. And not only do I agree, but I'm going to dive in a little deeper into some of the items you addressed. And first, insurance, medical insurance, health insurance, disability, long-term care. We help our clients make those decisions, but we also have consultants that work closely with Bash Capital that have experience and are specialists in those areas. So I always like to work in areas that I feel most comfortable, and that really comes to the retirement savings side. And step one, you have a 401k plan at work. We want to contribute to match the match that's being provided to you in the plan. So if you're using a traditional option and you're receiving a 4% match, we want to make sure our participant is putting in at least that much. That's free money going in. And if we look at a hierarchy of saving strategy, we can look to put other excess cash flow into a Roth IRA, where we are now providing tax-free benefits in a vehicle for later on. We then circle back to the 401k plan, and we want to put excess contributions of that match into the 401k plan to have a maximized benefit for our clients. So in the end, we're providing upfront tax savings, but also having a vehicle later on in life to have tax-free savings. That is one way that we work closely with our clients.
Matt, I love that hierarchy of savings that you just described, but I want to switch gears again now on you. And I want to talk about some year-end planning, and we often hear about creating checklists. So when it comes to the following year for our practice, is this something that you review with our clients?
Scott, great question. I'm going to say sort of. I love checklists. You know this.
He's the best. Love it.
I think you even sent me a book, Checklist Manifesto, that I need to work on. We'll get to that. So during the year, aren't we working with their cash flow planning, tax planning, insurance reviews. So we are already hitting those buckets. But at the end of the year, I do like to evaluate short and long-term goals. And I love practice what you preach. What did we plan to do in the beginning of the year? And let's look back. Did we hit those investment buckets with the amounts that we expected? Did we overpay certain debts with the amounts that we expected? It's a great way to see something that we put in place, that we strive for, we able to cross it off the list, and then going forward, creating those new goals and checklists for the following year. So we have something to try to attain and feel good about. So it's kind of like that financial workout. I would say yes, I do use a checklist, but it's really based on goals at the end of the year and what did we accomplish together.
It's interesting how that's an annual type of activity, whereas in my world, when it comes to portfolio management and risk performance analysis, this is a checklist that we're executing consistently throughout the year. As a matter of fact, I laugh because the markets have no idea about the calendar and the New Year's and anything from the emotional side that we talk about.
But see, they don't know that we know that they know.
Markets care about discounting future earnings. So when it comes to my checklist of managing our models, a lot of it begins with analyzing performance and risk and utilizing some of the practice metrics that I'm sure I'll put everyone to sleep with if I begin to talk about. But these are the important things that I'm looking at every day. And my checklist is really looking at the performance analysis, the risk analysis, looking at rebalancing. A lot of people do that on a quarterly basis. Again, it has nothing to do with the calendar. What your rules are for rebalancing has to do with the models that you're managing. When do you want to rebalance? It may have nothing to do with the calendar. And then I'm looking at my market analysis and my portfolio diversification. So yeah, right now with my year-end planning, it has nothing to do with the calendar. It has to do with the ever-changing market that we all work in. So it has to do with everything that we're seeing day to day. That's what is causing the change in our overall models.
Scott, great points, and you mentioned the word often there, change. And this is a crazy time, an exciting time for the market, and holidays coming up as well. Anything you want to add to the discussion and the points we touched on today?
I would tell all investors out there, one of the hardest things to do is what's called the pain trade. Do what feels painful. When there's blood in the streets, you're told to buy stocks. When everyone is selling, when everyone is buying, and that herd is following in the markets, the pain trade is the opposite. So sometimes it's prudent to take a haircut on that portfolio, especially at the end of the year.
Scott, good points, coming off a nice haircut that you brought to the table today as well.
Oh my god, your hair is different.
So I got nothing to add. That was a great way to end it. And as we always say to our investors, don't forget to stay focused, stay disciplined, and stay tuned for the next episode of The Bash.